first webinar of 2026 Q1. Important topic here. We are talking about the One Big Beautiful Bill Act. Very important as we are upon tax season. Can begin filing tax returns next Monday. So Jeffrey and I are getting ready to get really busy. So if we don't pick up our phones after about mid-February on the first ring, uh, we're working on tax returns. So anyway, buyer beware. But at any rate, we're excited. One Big Beautiful Bill Act tonight. We just want to point out a couple things that we want our audience to pay attention to that impacts the majority of people that we work with in doing taxes and tax planning and things of that nature. So we're going to jump right in. Just keep advised. We got two more coming up, two more wonderful sessions. Estate planning. I know you guys are going to want to join that one with estate planning attorney Mariah Street. And then real estate investors. Oh, we've got your tax loopholes coming up in March with a gentleman who's done several of those for us as well. So really two important ones coming up in Q1 2026 that we're looking forward to. With that said, I am going to pass it over to Jeff and I'll get the presentation going. And he's going to take over the presentation tonight of the One Big Beautiful Bill Act. Jeffrey, it is all yours.
Yeah, and I appreciate that, Marcus. So like Marcus said, today we're going to be walking through that one big beautiful tax bill and what's in it for the individuals, the businesses, what's new, how it's paid for, and what might be missing within that bill. I'll try to keep it pretty practical, kind of highlight the dates that matter and point out planning ideas that we might use. So yeah, let's start with the roadmap of what we're doing today. So we'll cover four areas, and that's the individual provisions, business provisions, brand new ideas like no tax tips on overtime, um, and finally the pay for it to offset the cost. So first up, the individual tax provisions. The seven tax brackets stay where they are. So we stay at 10%, 12%, 22%, 24, 32, 35, and 37. The standard deduction rises from $15,750 for filing single, or rises to $50,750 for those filing single. Those filing married and jointly rises up to $31,500, and for our head of the households filing, we got that at $23,625. There's also a temporary extra bump to the standard deduction. That's plus $1,500 in the first year for 4 years, beginning in 2025. So started last year, and then plus 1,000 in later years. Current law add-ons for those 65 plus or blind continue, generally plus 1,600 or plus 2,000 if unmarried. And then a new OBBBA add-on starting 2025 through 2028. Those give 65 plus an extra 6,000, even if they itemize. And this phases out above 150K for those married filing jointly and 75K for others. And then capital gain rates stay the same, or still have three rates, and that's 0, 15%, and 20%.
And I'll just add before we go to the next slide. On the standard deduction, it was an attempt by the administration as to lessen some of the taxes on Social Security. So that's why you're seeing some of those, especially those things for those age 65 and older. Those bumps there are designed to kind of make less of that Social Security tax bill. All right, so we'll move on to other individual provisions, specifically itemized deductions.
Yeah, so starting with that state and local tax deduction, SALT, as I'll say a lot in here. So SALT can jump up as SALT cap jumps up from 10K to 40K to married filing jointly, and 20K for those married filing single, starting in 2025 through 2030 with a 1% annual increase. So that would be 40,400 for those married filing filed jointly, in 2026, and so on. There are also phase outs, and those are up to 500K in modified adjusted gross income for those married filing jointly, and 250K for those married filing single, with a married filing single phase out of 600K and the 300K respectively. So the mortgage and interest deduction keeps the $750,000 loan limit permanently, and then home equity interest is excluded from that number. So
Yep, no
Charitable
change
gifts
there.
get a charitable gifts get a small haircut. Only the portion of giving that exceeds 0.5% of adjusted gross income is deductible. There's also a high income limitation. Reduce itemized deductions by two over 37 of the lesser of um, the amount of the deduction or the amount of the taxpayer's taxable income that exceeds the start of the 37% tax rate bracket. So just some
Yep.
simple framing. Think modest SALT relief, permanent mortgage rules, and a small flow on charitable deductions with a high income trim. It's
Yep.
kind of like a overcut. Yeah, and then we'll go into the child tax credit. So that's going to rise to 2,200 per child for 4 years starting in 2025. The refundable portion increases to 1,400, and then phase out still apply, and at least one parent must have a valid Social Security number. It was originally both for married filing jointly. Now it's just one. So in 2029, the credit um, drops back to 2002. So after that 4 year period, it drops back to 2000. The credit for other dependents go away. Um, and then, for example, families with younger children benefit the most from this between 2025 and 2028. However, households claiming other dependents lose that smaller credit. So,
Yep. That $500 is gone.
yep.
So claiming mama and daddy, and they didn't have income, it cost us $500. So they took that away from us. All right,
Yep.
on to the next part. The business tax provisions.
hmm So for pass-through entities, the 20% qualified business income deduction, or the QBID, is made permanent, and then 199A threshold index for inflation would be indexed for inflation. I'm sorry. And so for investments, 100% depreciation becomes permanent for qualified property placed in service on or after January 19th, 2025. Shout out to that date. That's my birthday. And then Section 179 expense and rises, maximum 2.5 million with the phase out beginning at 4 million. Um, so yeah, this just means more front loaded deductions for equipment, heavy and growing firms, and more certainty for QBID planning.
Yep. Oh, one thing we should point out as well is whenever we're talking about tax law and you see the word permanent, remember that that word permanent is in pencil.
Yeah.
So what that means is that um, for the tax law that just passed is permanent. So another administration can come in and repeal the tax law and change it. So
Mhm.
permanent means permanent under the current tax law. So just keep in mind, permanent is not in a Sharpie, it is in pencil. All right. Just wanted to throw
Mhm.
that in there.
So some more business provisions. Some other, like I said, permanent extensions. So keep that permanent with a grain of salt. Is interest deductibility and R&D deduction. So research and development deduction. And then for research and development, domestic R&D expenses would be immediately deductible for tax years 2025 through 2029. Um, Law does not provide full expensing for foreign R&D expenses. So this nudges companies to keep research activity and IP development onshore if they want that immediate write-off.
Absolutely. Yeah, good news here for business workers and their administrative costs.
Yep. So, like I said, third-party networking reverts to the prior rule for Form 1099-K. Um, Nets reporting at $20,000 in transactions and more than 200 aggregate transactions when that reporting number comes in. And then for Form 1099 NEC, the reporting threshold increases from $600 to $2,000, and it's indexed for inflation after 2026. So just fewer surprise tax forms for smaller dollar activity, and then contractors will see fewer 1099s for those smaller jobs because that report number is lower. So,
Yeah, so that'll help
or
out the
higher,
business
excuse me.
owner.
I'm sorry.
Yep, so that'll help out the business owner so they may not have to uh, produce as many 1099. So trying to reduce some paperwork. That's
Exactly.
part of the Paperwork Reduction Act there.
hmm Yep. So we got some new provisions. No tax on tips. That's the big new one. So tip income is temporarily deductible, and it functionally on an above the line deduction up to 25,000 from 2025 to 2028. Tips are still subject to payroll taxes. High compensation employees excluded above $160,000. Treasury will publish a list of tip earning jobs. So that's important. And then second, no tax on overtime and above the line deduction up to $12,500 for those filing single and $25,000 for those filing jointly, married and jointly, through 2028 from 2025. Overtime phases out starting at an adjusted gross income for 150K for singles and 300K for married filing jointly. Singles are fully phased out at 275K, and overtime is the amount paid above the employee's regular rate. So, third is a comeback for car loan interest becomes deductible again for new vehicles assembled in the U.S. So, no campers or RVs are included in that. And then from that's again 2025 to 2028. The deduction is capped at $10,000 with income phased out at 100K single and 200K for those married filing jointly. And historically, car loan interest was deductible until 1986. So this is the targeted temporary revival.
Yeah, so this could be a tax planning opportunity for those for some because especially if you're in a higher tax bracket and you can deduct some of your interest and get
Mhm.
a tax benefit from it. So that's definitely something strategic to think about with your tax planning.
Yeah, and opportunity zones are back.
Yep, I'll probably jump in and take this one real quick because I'm probably a little more versed on this. So opportunity zones are place where business owners, as well as those with real estate capital gains, can kind of kick the can down the road on some of their taxes. So again, we got a gap year, so they're not effective until 2027 technically. So a lot of tax planning will have to go into those. And I don't want to do too much here other than to say that they're there. But we're going to have that real deep dive in March on this topic and really get into the weeds about how opportunity zones work, 1031 exchanges from a real estate perspective. Um, so just know for tonight's purposes that opportunity zones are back as a joint deal between Cory Booker and Tim Scott. Originally came up with this in 2017. Uh, Fabulous way to compound some money and save on taxes. So we'll again March. Be sure you sign up for that one because we're really going to delve down on how we can compound some money here.
Mhm.
All right, then we'll get into how are we paying for all this? How are we paying for this stuff?
Medicaid. So starting December 31st, 2026, able-bodied adults must work, volunteer, or attend school for 80 hours per month. Beginning October 1st, 2028, certain participants would pay $35 for some appointments. So expect more frequent eligibility checks was the biggest thing, as well as a quite a little bit of a bump up in for some of those appointments. And then federal funds could also be blocked for beneficiaries with unverified citizenship or immigration status, and facilities that provide abortion services are also going to be some of that federal
Covered it.
funding is going to be blocked for that.
Yep, gotcha.
Hmm. Yeah, and so that earned income tax credit, there's a bigger push to catch duplicate claims right now. So, for example, when a child's social security number is used more than once, the IRS may delay refunds until October 15th when eligibility is verified. There's also a pre-certification track to avoid delays. A new task force will also be exploring administration improvements, including a third-party payroll, spending data, and automatic verification. Um, yeah, and then advisors are also gonna be reminding people nowadays about EITC eligible clients to file early and kind of maintain some of that documentation to avoid the delays. So that's going to be a big one.
Yeah, I tried to do some research. I wasn't able to identify the pre-certification process. I don't think it's been established yet. So as
Hmm.
Jeffrey is saying, just simply file as normal and just make sure all of your back-ended things are in place as the government systems can now kind of cross-check between Obamacare, social services, and your tax forms, so that all those systems can talk to one another now. So just make sure everything's consistent as you're looking at that piece.
Yep. And so then we go into the Inflation Reduction Act. It is expiring September 30th, 2025. So it already expired. And then previously owned clean vehicle credit, the clean vehicle credit, and then qualified commercial clean vehicle credit are all part of that. And then expiring, those are the ones expiring September 30th, 2025. The ones that expired on December 31st, 2025 were the energy efficient home improvement credit. So that credit towards the energy efficient home, the residential clean energy credit, was also expiring that date. And then as we're going into this year, expiring in June 30th of 2026 will be the new energy efficient home credit, efficient commercial building deduction, and an alternate fuel vehicle refueling credit. Excuse me. So we're losing a lot of those things around clean energy, EV, and home energy products. So um, yeah, that's kind of where they're getting some of that money back from.
Yeah, absolutely, absolutely. Yeah. So when not giving up those credits, that'll generate some revenue as well.
Hmm.
So yeah, so awesome. So that's a good recap of what the bulk of us Americans are going to be dealing with the tax law. As you noted throughout the presentation, there some of these are only for short periods of time. So permanent, temporary is kind of the theme of tonight. So again, as you plan, get with your tax preparer, your financial advisors, things of that nature. We're already huddling up with people in terms of what we're doing with tax strategy. Well, we've been doing that because that's part of what we do on a normal basis. But of course, getting ahead of this tax planning for this year and going forward. So again, we look forward to having you all on the next webinar, estate planning in February. I think that's on the 10th. It's Tuesday night as well. But it's on our website. Be sure to check out our website, visit us on our socials. We're promoting it. And until then, we will see you guys next time. Thank you so much for your time. Good evening.
Thanks, everybody.